Hello to everyone. Today I am here with Risk and Return Financial Management Part 3. Basically, it's the continuation of the Part 2. The areas we have covered in Part 2 include the calculation of expected return, calculation of standard deviation, risk evaluation by applying standard deviation, and risk evaluation by applying coefficient of variance. In the previous part, we have covered these topics for standalone basis. Now, in this part, being the continuation of the previous part, we are going to calculate the risk evaluation of portfolio by applying standard deviation, coefficient of variance, etc. Now, here we have observed that the steel sector having the maximum level of the risk among the four types of the securities. Now, here we are going to calculate the portfolio expected return. There are two methods. First is expected return of portfolio weighted average method. Now, here we can see if we say that the trading investment is 20% of the portfolio. For example, I have invested 1,000. Out of 1,000, 200 is invested in trading bank. In case of a pharma, it's 30%. It means out of 1,000, I have invested 300 rupees in pharma. Thereafter, 22 220 invested in food and 280 invested in steel. So the sum of all the investment comes equal to 1,000. Now there are two methods. One is by applying the weight method. In the previous slide, we can see expected returns are 22%, 19.5%, 31.85%, and 25.75%. These are the expected return against the all type of the security. In the first method, we are going to multiply the probability, multiply the weight with the expected return. Now here, 20% is for trading bell, and its expected return comes to 22%. For pharma, the weight is 30% and the expected return is 19.55%. In case of food, we have the weight is 22% and expected return is 31.85%. In case of the steel, we have weight is 28% and the expected return is 25.7%. It comes 24.48%. Second method is probability multiplied by proportion. Now, how we calculate the proportion? For the first case, you will multiply by this return 22 multiplied by 20. 22% multiplied by 20% plus 25% multiplied by 30% plus 45% multiplied by 22%. Thereafter, 50% multiplied by 28%. The proportional rate comes to 35.80%. In case of boom, and its probability is 15%. For the average, above average, the probability is 20% and its proportional rate will be calculated 22% multiplied by 20%, 22% multiplied by 30%, 42% multiplied by 22%, and 40% multiplied by 28%. The sum of all these comes equal to 31.44%. In case of a boom, probability is 30% and the first return 22% will multiply by 20%. 20% will multiply by 30%, 35% will multiply by 22%, and thereafter 30% will multiply by 28%. The sum of all these calculations comes equal to 26.50%. For the below average, probability is 20%, and this return 22 will multiply by 20%, 18 will multiply by 30%, 25 will multiply by 22%, 10 will multiply by 28%. The sum of these all returns comes equal to 18.10%. Recession, in case of a recession, the probability is 15, 22% multiplied by 20%. 12% will multiply by 30%, 8% will multiply by 22%, minus 5% will multiply by 28%. The proportional sum of these all returns equal to 8.36%. Now here we are going to calculate the probability is 15. 15 multiplied by 35.80, then 20 multiplied by 31.44%. Thereafter, 30 probability 30% will multiply by 26.5%. Thereafter, probability 20 will multiply by 18.10%, and lastly, probability 15 will multiply by 8.36%. You will find the similar answer. It's up to you which method you want to adopt, because when we go for the comparison between the different portfolios, we usually choose the second method. So it's up to you. Here we have the calculation for the expected return that comes against the portfolio equals to 24.84%. Thereafter, standard deviation by weight. Here we have probability is 20 multiplied by 0. Probability is 30 multiplied by 3.8%. Probability is 22 multiplied by 12.1%. Probability is 28 multiplied by 18.0%, and it comes equal to 8.87%. Now just move to backward. Here we have the figures for the standard deviation. For Tradible, it's 0. For pharma, it's 3.84. For food, it's 12.1. And for steel, it's 18.05. So these we have used here. Here we have used the same return, same standard deviation figure, but not in percentage. Now, for the alternative calculation, in case of the alternative, here we have the alternative calculation. So what you are going to do is, your expected return for portfolio is 24.48 for all cases. For the first case, the standard deviation is 35.8. For the second, the standard deviation is 31.44. For third, standard deviation is 26.5, and for fourth, it's 18.1, and for the last, it's 8.36. So after calculating the standard deviation, we have the similar answer, that is 8.87%. After calculating this, we have calculated the coefficient of variance that comes to 0.36. It means the coefficient of variance having the lower value. So it means the portfolio is low risk. When you have the comparison between the different portfolios, in that case, you can compare which portfolio is high risk portfolio and which portfolio is low risk portfolio. Now you can have the different securities, and on the basis of those securities, you can develop the portfolio. And after developing the portfolio, you can calculate the level of the risk for each portfolio and can take your investment decision. Thank you very much. See you again with the upcoming video on the same topic very soon.